Forms of business organizations. There are different categories of business organizations that relate as to how the business is established, owned, and operated. The basic categories of business organization are sole proprietorship, partnership, corporation, and cooperative. Sole proprietorship. This business usually is owned by one person, called owner. The owner has the day-to-day responsibility to run the business. In sole proprietorship, the owner is the business, as there is no legal distinction between the business and the owner. The advantages of this form are, the owner receives all the profits, the business is very easy to operate, least expensive, and is not subject to different organizational regulations. The owner simply reports profit and loss from the business on his personal tax return. On the negative side, there is unlimited liability if anything happens in the business. The owner's personal assets are at risk because he is the only one who is personally liable for any debts, contracts, negligence, or wrongful acts done by the business. Partnerships. In a partnership, two or more members, called partners, share ownership of a single business. Like proprietorship, the law does not distinguish between the business and its owners. The partners should have a legal agreement that establishes how decisions will be made, how profits will be shared, how future partners will be admitted to the partnership, how disputes will be resolved, how partners can be bought out, or what steps will be taken to dissolve the partnership when needed. Like any other business structures, partnership has advantages and disadvantages. On a plus side, separate legal status gives liability protection, profits are taxed only once, partners may have complementary skills. However, on its negative side, partners are jointly and individually liable for other partners' actions, profits must be shared with the partners, decision-making is divided among members, and the business can suffer if the detailed partnership agreement is not in place. Corporations. A corporation is considered by law to be a unique entity, separated from those who own it. A corporation can be taxed, sued, and enter into contractual agreements. It consists of 5 or more members called stockholders or shareholders. The corporation has a life of its own and does not dissolve when ownership changes. It is highly regulated by state rulings, and is rather inflexible in the manner they can be organized and managed. The shareholders select a board of directors by election. The board then develops corporate policies and strategies. The officers of the corporation run the day-to-day operations. Shareholders' liabilities are limited to their investment, which means the most that shareholders can lose is their investment in the corporation. In addition, corporate taxation can be very complex. Big corporations are taxed at 2 levels, the corporate level and the shareholder level. In other words, the government taxes the corporation on its income, and then taxes the shareholders on the dividends that the corporation distributes to its shareholders. Cooperative. A cooperative is a private business organization that is owned and operated by the people to meet the specific objectives of members, and is structured to adapt to members' changing needs. It is established for the purpose of purchasing and selling the products of its members, and procuring supplies for resale to the members. The income is distributed to the members in the form of patronage dividends, and not on the basis of equity investment of the members. In a workers' cooperative, the members jointly produce a product, and the distribution of income of the business is based on the amount of labor they contribute. But then, cooperatives are often focused on services for members rather than for investments.